Hi, I'm Grant Stephen.
And I'm Kris Bernier.
And we're the Two Investment Guys. This week, Kris and I want to talk a little bit about the markets, but mostly about some guiding principles that investors need to hold near and dear to their hearts. You know, when we look at the markets around the world, so far this year, at least in the major markets, they're up anywhere from 6 to 16%. So we're 4 months into a rally here. You know, it's interesting, Kris, that we've talked about watching fund flows in the past. We're 4 months into a rally and we're just now starting to see the equity inflows occur in funds. And that's a pretty telling tale that we've described before, how often retail investors get late to the game. So let's talk about some of these guiding principles that can help keep you above board and you're thinking true and clear on what you're trying to do with your investments. Kris, why don't we start with history?
Sure. Well, it's a good point because we've had a very strong start to the year. And one thing is, believe in history. Bubbles do pass and frenzies pass. So, don't get too caught up in the euphoria of what's going on in the market, I think is what we're trying to say there.
Yeah, and as well, when the negative sentiment and the headlines are awful, Kris, also be very careful about being a borrower and a lender. In other words, we're talking about the concept of leverage. When everything is great, that's when people tend to get exuberant, Kris, and just be very, very careful about your use of leverage if you use it at all in the markets.
That's right. And don't put all your treasuries in one bond, or as we say, don't put all your eggs in one basket. Diversification is the best risk reduction technique we know in the markets today.
Yeah. You know, one of the classics, Kris, is stay focused and be patient. Don't be influenced by headline news because it ramps around like crazy every day, and create a lot of negative sentiment for a period of time. So again, just be patient and stay with it and stay focused.
That's right. And we've said many, many times, be paid regularly to wait. We think growth is going to be slow to come by for the next couple of years potentially, so focus in on the income that your investments produce.
Another point would be to contain your natural optimism, at least in these markets, and up until about 4 months ago, be wary of the negative sentiment that influences your decisions. Optimism is sort of a natural human trait, Kris, and it needs to be kept in check so that you're honestly assessing the types of things you own and why you own them, instead of just, it'll always get better and it's great. Sometimes you do need to make changes.
And on rare occasions, try to be brave. We saw this last fall when it looked like the world was falling apart, and since then we've seen a tremendous rally in the markets. Yeah.
Resist the crowd. It's pretty easy when everyone's piling in at the same time or piling out. It just feels like the right thing to do. But all the academic work that Kris and I have ever seen on this proves that usually the opposite, in fact, is the right thing to do.
That's right. And above all else, to thine self be true. And what we mean there is know and understand who you are as an investor, and in particular your tolerance for risk. And don't try to step out of those bounds to eke out a little bit potentially better return. I want to thank you again for your questions and comments. Please keep them coming. You can reach Grant and I at TwoInvestmentGuys.com.
Join us next time. Kris and I are going to turn back to the markets, and we're going to detail some more of the dynamics going on there. So until then, I'm Grant.
And I'm Kris.
And we're the Two Investment Guys.